The death cross. Let's have a look at it. Hashtag BTV 3032. This is for the DAX. We could have shown the Stoxx 600. Is it a big deal or not?
Well, it certainly is. Put it this way, it can be. We've had the death cross become apparent for, as you said, the DAX, for the Stoxx 600, for the FTSE 100, and quite often with the momentum that happens when a 50-day moving average crosses through the 200, which is the death cross, it just precipitates more technical selling. We've also got relative strength indicators, RSIs, that have gone negative from the standpoint of the trend that they are showing. But go back to 2006. There have been 7 prior death crosses for the Stoxx 600. 4 of them actually were followed by notable rises in the market when there was good underlying fundamentals. 3 of them, there were crises, whether it be the global financial crisis or sovereign crisis and whatnot. The question now is, fundamentally, what do we have with things like trade? What do we have with things like currency? That's going to matter, not the death cross.
And on that note, Tim, you're good. You're good. You know what's coming up next. Hashtag BTV 65. This is the correlation between the Stoxx 600 and the euro turning more negative.
Well, it's a funny thing. If you can look at it from the stock price like this, you could draw a correlation with the euro and Stoxx 600 earnings, or the FTSE earnings with the pound, and it's a clear negative relationship. The region gets a lot of revenue and earnings from abroad. And if you have a strong currency, you're importing back in, translating back in weak foreign currency. It's straight up, particularly bad for the euro, for the FTSE. And that's a challenge going forward. If we continue to have trade disruption, concern about politics in the U.S., things along those lines, that's supportive of the euro, and that's a headwind going forward. It clearly has been a big reason why we've got much slower growth anticipated in 2018 for Europe than what we thought we were going to have back in December.
Is that the main reason why the performance has been so poor, both on absolute terms and relative terms to the U.S., even though tech hasn't been such a big driver in Europe?
Well, I think that has a lot to do with it, Bonnie. It's one of those things where in the U.S., we've had tax reform that was a big cut. We've had a weak currency with the dollar being down as much as it is. And you've now got the flip side of that in Europe with a strong currency being a headwind. Trade obviously causes concern, but from a European perspective, it's particularly potent because you've got something on the order of 30% of revenue that come from abroad, and that's trade-oriented ties that could be potentially disrupted. That's quite notable in terms of the difference between the U.S. and Europe. I'd throw out as well that we've had different phases in the underperformance. You had late last year that was the tax reform boost for the U.S. You had early this year where you had rate rise concern with the ECB and whatnot, and you had financials outperform and everything else be bad. And then you've had the trade concern since late February, where the cyclical components like discretionary, autos, industrials have been particularly weak.